Hi, I am Asif Suria. I am the author of The Event-Driven Edge in Investing. I'm based in the San Francisco Bay Area and I've been investing for 23 years, including as a professional investor. I'm here today to talk about common mistakes that investors make. And one of the biggest mistakes an early investor, somebody who's just starting out, can make is they make an investment in a company or maybe a sector through an ETF, and things don't work out the way they expect it to. And they give up on investing thinking this doesn't quite work. That, in my opinion, is one of the biggest mistakes you can make because staying invested over the long run can really have a transformative impact on your portfolio, on your life, especially considering we have a lot of inflation in the economy, and not investing would mean that the money that you own or you already have is going to go down in value. So even if things do not work out, quitting investing altogether can be a very big mistake. The other thing to think about when it comes to mistakes is I have learned a lot from my prior mistakes. There was a time in the 2010s when I was an energy market tourist where I didn't fully understand how, for example, oil and gas worked. But the mistakes I made and the losses that I took at that point in time helped educate me on different companies in the industry. And that had a very positive impact when the industry cycle changed. And I was able to learn from all the mistakes that I made. So the mistakes that you make or the money that you might lose in the early days is just tuition that you're paying to the market to learn about a company or an industry, and that will pay off in the long run. Another common fallacy among investors is they concentrate their positions. So you might have a portfolio with just 4 or 5 positions. That can work really well for a highly experienced investor who has done a lot of work in understanding the companies, but not for somebody who's just starting out. If you're somebody who's just starting out, a broadly diversified portfolio of 25 to 30 stocks across industries might be a better approach than concentrating a portfolio to just 4 or 5 companies. A third fallacy is doubling down on something that's not working. So if you've done the work up front, you make an investment and you see that the stock is going down, either you're wrong or the market is wrong. And it's very common for investors to think it is the market that's not wrong and you are not in the wrong, that you made all the right, that you did all the right analysis and that the stock is eventually going to go up. That is just the tip of the mistake, if you will, because often what happens is you convince yourself that you're right and that you should double down on the stock. If it has fallen 30% from where you purchased it, you might think of it as being 30% cheaper. It's trading at a discount to what you thought it was worth, and you want to buy more. But doubling down on losing investments doesn't often work very well. It's best to understand that you made a mistake and to move on. Both the emotional and the monetary cost of doubling down on investments can have a very detrimental impact on your overall portfolio. Often it is better to double up on investments that are working for you. So if you bought something and you can see that the company fundamentals are improving and the stock is going up, adding more to that position makes a whole lot more sense than doubling down on something that's not working. Markets have different cycles, and attempting to time the market could mean that you have to be right when you're getting your money out of the market, and you have to be right a second time to pick the exact time to get back into the market. Timing the market can have a significantly detrimental impact on your portfolio. It's best to stay invested fully all the time, or to scale back your positions to a certain point rather than exiting the market altogether. You can also diversify across different asset classes. So you can have a certain amount of money in stocks, you can have some of your money in bonds and some in commodities. And you can reallocate between those asset classes rather than exiting the market altogether. So timing the market requires two right decisions, and more often than not, people lose money trying to time the market. Another mistake that investors make is having home country bias, where you only want to invest in companies from your home country. So if you are based in the US, you might only want to buy Nike and Coca-Cola and Starbucks, but that might not give you exposure to other industries and other countries. So being open to incorporating other investments from different sectors, from different countries, is going to be helpful to your portfolio in the long run, because when some things are not working in your portfolios, others will offset the impact on your portfolio. If, for example, one country is going through a deep bear market, like we experienced in 2001 to 2003, as well as from 2008 to 2009. Thank you for watching this video. My name is Asif Suria, and I'm the author of The Event Driven Edge in Investing.